Netflix just reported its second quarter earnings, and on the surface, these results look strong. Revenue is growing at a double-digit rate, profits are climbing, and the company continues to generate billions of dollars in cash. So why did the stock fall after earnings? In this video, I'm breaking down Netflix second quarter results, take a look at the charts, discuss the three biggest risks to the business, and I'll give a one-year price target for the stock. Everything on this channel is free. I'll never try to sell you a course or a membership. I'm just a normal guy who loves investing. Let's generate alpha. Here are the headline numbers. Netflix generated $12.56 billion in revenue during the quarter, representing 13% year-over-year growth. That growth was driven by continued membership gains, recent price increases, and a rapidly expanding advertising business. While those numbers are impressive, revenue came in just below Wall Street's expectations. It was only a small miss, but investors had become accustomed to Netflix consistently beating expectations. Profitability remained one of Netflix's biggest strengths. The company reported net income of $3.4 billion, up about 9% from the same quarter last year. Earnings per share came in at 80 cents, narrowly beating analyst estimates. This demonstrates that Netflix continues converting revenue growth into higher earnings while maintaining strong operating leverage. Operating margin remained high at 33.4%. One of the most exciting parts of the earnings report was the advertising business. Management expects advertising revenue to roughly double this year to around $3 billion, making ads an increasingly important growth driver alongside subscriptions and price increases. This is significant because advertising opens up an entirely new revenue stream without relying solely on adding more subscribers. Netflix also continued producing substantial cash. The company generated approximately $1.5 billion in free cash flow during the quarter, giving it plenty of flexibility to invest in new content, expand its platform, repurchase shares, and strengthen its balance sheet. Free cash flow remains one of my favorite metrics because it represents real cash available after all operating and capital expenses. So why did the stock fall after earnings? The answer wasn't the quarter itself, it was the outlook. For the third quarter, Netflix expects approximately $12.86 billion in revenue and earnings per share of 82 cents, both slightly below what Wall Street was expecting. The company also narrowed its full-year revenue guidance to $51 to $51.4 billion, while maintaining its target operating margin of 31.5%. Investors are beginning to wonder whether Netflix is entering a slower phase of growth after several exceptional years. Let's take a look at the charts. Following earnings, Netflix experienced a sharp sell-off, with the stock dropping more than 10% in a single session as investors reacted to softer forward guidance rather than the quarter itself. Starting with the 50-day moving average, the stock is now trading below this level. That's generally considered a bearish signal because it tells us that short-term momentum has weakened. Over the past couple of months, buyers have clearly lost control and sellers have taken over. Looking at the 200-day moving average, Netflix is also trading below this longer-term trend line. This is a more significant development because the 200-day moving average is widely followed by institutional investors. When a stock falls below both the 50-day and the 200-day moving averages, it suggests the market is becoming more cautious about the company's near-term outlook. The relative strength index has dropped to around 32, which means Netflix is approaching oversold territory. Remember, an RSI below 30 doesn't automatically mean the stock is a buy. What it tells us is that the selling may have become a little excessive in the short term, and historically, that's where we sometimes start to see buyers step back into the market. So what would I like to see from here? First, I'd like to see Netflix stabilize and begin forming a base instead of continuing to make lower lows. Second, I'd want to see the stock reclaim its 50-day moving average, which would suggest that short-term momentum is improving. For long-term investors, technical indicators shouldn't be the only factor in your investment decision. I always believe the fundamentals come first. If the business continues growing revenue, earnings, and free cash flow, today's chart may simply end up looking like another temporary setback. But in the short term, there's no denying that the technical picture has weakened, and it's something investors should keep an eye on. Now, no investment is without risk. As impressive as Netflix's business has been, there are three key risks that investors should keep an eye on over the next few years. The first risk is subscriber growth. For years, Netflix's success was measured by how many new subscribers it added every quarter. Today, the company has over 325 million paid memberships worldwide, making it the largest streaming platform in the world. The problem is that as Netflix becomes larger, it naturally becomes harder to keep growing at the same pace. Many developed markets like the United States and Canada are already highly saturated. Most people who want Netflix already have it. That means future growth will increasingly rely on international markets, where subscription prices are generally lower and competition is becoming more intense. If Netflix struggles to grow subscribers, revenue growth could begin slowing as well. The second risk is competition. When Netflix first entered streaming, it had very few serious competitors. Today, the landscape looks completely different. Consumers now have endless options competing for people's time. The challenge isn't just competing for subscription dollars, it's competing for attention. Every hour someone spends on TikTok, YouTube, or gaming is an hour they're not watching Netflix. That means Netflix has to continue producing hit shows and movies year after year just to keep viewers engaged. One or two disappointing content years could easily impact subscriber growth and pricing power. The third risk is valuation. Even after the recent pullback, Netflix still trades at a premium valuation compared to many mature media companies like Disney. The market expects Netflix to continue delivering strong revenue growth, expanding operating margins, growing advertising revenue, and generating increasing free cash flow. That's a very high bar. When expectations become this elevated, sometimes even great earnings aren't enough. We saw that with the latest quarter. Now the big question, where could the stock go from here? Most analysts maintain a buy rating with an average price target of about $98. Looking at the discounted cash flow model, the base case estimated value for the stock is about $73, and the best case is $135. Please keep in mind that DCF is highly sensitive to assumptions. Even small changes to growth or discount rates can swing the fair value dramatically. As for my opinion, I am giving Netflix a buy rating and maintaining a one-year price target of $130. Here are 3 reasons why I believe it's a buy for long-term investors. The first reason is simple. Netflix prints cash. During the most recent quarter, Netflix generated approximately $1.5 billion in free cash flow, while earning around $3.4 billion in net income. These aren't the numbers of a company that's struggling. They're the numbers of a mature, highly profitable business. Netflix can use that cash to produce more blockbuster content, invest in new technologies, repurchase shares, or strengthen its balance sheet. The stronger the cash flow becomes, the more options management has. And that's exactly what long-term investors want to see. The second reason is the advertising business. This could end up being one of Netflix's biggest growth opportunities over the next decade. For years, Netflix relied almost entirely on subscription revenue. Now it has 2 engines driving growth. Management expects advertising revenue to roughly double this year, and while it's still a relatively small part of the overall business today, it has enormous long-term potential. Netflix already has hundreds of millions of highly engaged viewers spending hours on the platform every week. If management can successfully monetize that attention through advertising while keeping customers happy, it could significantly increase revenue and profit margins over time. The third reason is management. Netflix has repeatedly shown that it's willing to change when necessary. People criticized Netflix when it cracked down on password sharing. Many investors thought subscriber numbers would collapse. Instead, subscriber growth accelerated. People questioned whether Netflix could compete against Disney, Amazon, and Apple. Yet Netflix remains the world's largest streaming platform. Now the company is expanding into live sports, live events, gaming, advertising, and AI-powered recommendations. Management isn't standing still. They're constantly looking for the next growth opportunity. And companies that continue to innovate often outperform over the long run. When investing, don't just ask whether a company had a good quarter. Ask whether the business will be stronger 5 or 10 years from now. Personally, I think investors may be focusing too much on a slight revenue miss and softer guidance. When I look at this business, I still see revenue growing at 13%, profit continuing to increase, around $3.4 billion in quarterly earnings, roughly $1.5 billion in free cash flow, a fast-growing advertising platform. Those aren't the numbers of a company in trouble. It looks like a buying opportunity to me. Let me know in the comments, what do you think of Netflix? Is it a buy at these levels? Thanks for watching. If you enjoyed this video and want more earnings recaps with one-year price targets, please like and subscribe. Until next time, keep earning, keep saving, and keep investing. I own Netflix shares through an S&P 500 index fund. This is not financial advice, just my personal opinions. Make sure you consider your own risk tolerance, time horizon, and financial situation before making any investment decisions.